Priya, a bright and ambitious 28-year-old software developer, dedicated to her craft, just received her annual bonus, a significant 1 lakh rupees, a welcome addition to her savings and a chance to make it grow. Her parents, with years of experience and a traditional mindset, urged her to put it in a fixed deposit safe, guaranteed and trusted, a haven for her hard-earned money, they believed. But her colleagues, a younger, more risk-tolerant bunch, scoffed. Mutual funds, they said, were the way to real growth, the path to building wealth and achieving financial freedom. Rohan, her team lead and a self-proclaimed investment guru, showed her his investment app, full of rising graphs and talk of compounding. He painted a picture of exponential returns and a brighter financial future. Priya stood at a crossroads, the security of FDs, a familiar comfort, or the potential of mutual funds, a thrilling unknown. This isn't just Priya's dilemma, it's the question every young Indian earner faces as they navigate the world of personal finance. Do you choose the slow, steady tortoise, representing the reliable but modest returns, or the fast, riskier hare, promising rapid gains but with the potential for setbacks? Understanding both options, their pros and cons, and the risks involved, is the first step to making your money work for you and building a secure financial future. Let's break down what FDs and mutual funds really are and help you make an informed decision. Let's break down 2 common investment options: fixed deposits, often called FDs, and mutual funds. A fixed deposit is simple. It's a straightforward way to save. You lend money to the bank for a set period. Think of it as a loan you're giving to the bank, with the understanding that they'll return it with interest, and they pay you a fixed interest rate, guaranteed, no surprises. This rate is decided up front, so you know exactly how much you'll get back at the end of the term. If you're finding this helpful, please like and subscribe for more finance tips. It's safe, predictable, and your returns don't change with the market. This makes FDs a popular choice for those who prioritize security. Mutual funds, on the other hand, pool money from many investors. It's like a group of people coming together to invest as one. A professional fund manager invests this pool in stocks, bonds, or both. They make the decisions about where the money goes, aiming to maximize returns. If the companies do well, your investment grows, meaning the value of your mutual fund units increases. If not, it can shrink. The value of your investment is directly tied to the performance of the assets within the fund. With FDs, you're a lender to the bank. You have a guaranteed return on your investment. With mutual funds, you're a part owner in many businesses. Your returns are linked to the success of those businesses. FDs offer certainty, but limited growth. They are ideal if you want to preserve capital and earn a modest return. Mutual funds offer higher potential returns but with risk. The potential for growth is greater, but so is the possibility of losing money. One is a safe bet, a reliable option for those seeking stability. The other is a chance to grow with the market. It's an opportunity to participate in the potential upside of the economy. The choice depends on your comfort with risk and how much volatility you can tolerate in your investments, and your financial goals. Are you saving for retirement, a down payment on a house, or another long-term objective? Let's look at 2 friends in 2005. Aman chose FDs. Samir chose equity mutual funds. Aman's FD, renewed over 20 years at 7% interest, grew his Rs 1 lakh to about Rs 4 lakh safe, steady but modest. Samir's mutual fund, tracking the Nifty 50, grew at around 14% per year. His Rs 1 lakh became nearly Rs 14 lakhs. The difference? FDs protected Aman's money, but inflation ate into his gains. Samir took more risk, but his wealth multiplied. Past performance isn't a guarantee, but history shows the power of long-term equity investing. The gap isn't just a few rupees, it's life-changing. So, what's the catch? Let's talk risk. FDs, or fixed deposits, are generally considered ultra-safe investments. They offer a guaranteed return, providing a sense of security for your principal amount. This makes them a popular choice, especially for those who are risk-averse and prioritize capital preservation above all else. To further enhance their safety, your money in FDs is insured up to Rs 5 lakhs per bank by the DCCC, a subsidiary of the Reserve Bank of India. This insurance provides a safety net in the unlikely event of a bank failure. But there's a silent risk that often gets overlooked. Inflation. Let's say your FD earns 7% annually, and the prevailing inflation rate is 6%. After accounting for inflation, your real gain, or the actual increase in your purchasing power, is just 1%. Plus, the interest earned on your FD is subject to taxation according to your income tax slab. This taxation further shrinks your returns, potentially eroding the real value of your investment over time. On the other hand, we have mutual funds, and particularly equity funds, which invest in stocks. These funds have the potential to beat inflation and grow your wealth at a faster pace compared to traditional FDs. To mitigate risk, they spread your money across a diverse range of companies and sectors. This diversification helps in reducing the risk associated with the failure of any single company or industry. However, it's crucial to remember that markets are inherently volatile, meaning the value of your investment can swing significantly, experiencing both upward and downward movements. Therefore, if you panic and make the mistake of selling your investments during a market downturn, you run the risk of incurring a financial loss. This is precisely why equity funds are best suited for achieving long-term financial goals and should not be considered for short-term financial needs or emergency funds. Historically, over a period of 7 to 10 years, markets have shown a tendency to recover from downturns and ultimately reward investors who remain patient and stay invested. FDs offer protection and stability, while mutual funds provide the potential for higher growth, and each plays a vital role in a well-rounded financial plan. So, with these factors in mind, how do you determine the right choice for your specific financial situation and goals? The best choice depends on your goals and time frame. Use FDs for short-term needs, like a house down payment in 2 years or your emergency fund. For long-term goals, retirement, your child's education, mutual funds are your ally. Start a SIP in a good equity fund to build wealth over decades. List your goals. Under 3 years, stick to FDs. Over 5 years, lean into mutual funds. For goals in between, consider hybrid funds. Don't pick just one. Balance both for safety and growth. That's how you build a strong financial future. Please like, share and subscribe my channel so that it motivates me to create more videos which help in wealth creation.